January 5th, 2026, 11:37 a.m. EST. While financial media scrambles to cover the heroic liberation of Venezuela, I'm watching something far more consequential. Silver lease rates in London just spiked to 8.2%, the highest level in 47 years. COMEX inventories dropped 4.1 million ounces in 72 hours. Shanghai vaults are reporting delivery delays for the first time since 2008. And spot silver, which opened Monday at $75.86 per ounce, is now trading at $80.40, with bid-ask spreads widening to levels that suggest something is fundamentally broken. This isn't speculation. This isn't volatility. This is a liquidity crisis masquerading as a geopolitical rally. And if you think silver hitting $347 by Friday sounds insane, you haven't been reading the delivery failure notices that started hitting institutional desks at 3 a.m. this morning. Welcome to the Gray Ledger. I'm your AG Asian guy, and today we're going to walk through exactly why the Venezuela operation is not just another regime change story. It's the trigger event that's about to expose the most dangerous lie in global commodity markets, that there's enough physical silver to back the paper contracts. Let me start with a number that should terrify every trader holding silver futures: 230 million ounces. That's the cumulative supply deficit silver has run for 5 consecutive years, 2021 through 2025. Global demand has exceeded mine production and recycling by 230 million ounces. That's equivalent to Mexico's entire annual silver output, the world's largest producer, completely vanishing from the market. Where did that silver go? Into industrial applications that can't be recovered. Solar panels consumed 162 million ounces in 2025 alone. Once silver is soldered into a photovoltaic cell, it's economically unfeasible to extract. It's gone. Electric vehicle components took another 35 million ounces. Semiconductor manufacturing consumed 28 million ounces. AI data centers, this is new demand that didn't exist 3 years ago, consumed 14 million ounces for server components and cooling systems. Add it up. China's new export restrictions, starting January 1st, 2026, require companies to have annual production capacity of at least 80 tons and obtain special government licenses to export silver, investor news. Translation: hundreds of smaller and mid-sized refiners that supplied 40% of global refined silver have been cut off overnight. Now overlay the Venezuela crisis, and here's where the market mechanics get dangerous. Silver rose nearly 4% toward $76 per ounce on Monday, extending gains after the US attacked Venezuela and arrested President Nicolas Maduro over the weekend, heightening geopolitical risks, Fox Carolina. But this isn't just safe haven buying. Venezuela holds the largest gold reserves in South America, estimated at around 161 metric tons, valued at close to $22 billion, Chicago Tribune. And Venezuela is Orinoco Mining Arc, which we covered extensively in our last briefing, contains significant silver deposits intermingled with gold and rare earth extraction. Here's what the market hasn't priced in yet. Venezuela was quietly exporting 2.3 million ounces of silver annually through intermediaries to China and Russia. That supply just went offline, permanently. The moment U.S. forces secured Caracas, those supply chains were severed. China loses access, Russia loses access, and 2.3 million ounces, roughly 0.2% of annual global supply, just evaporated. You're thinking, that's a rounding error? And normally, you'd be right, but we're not in a normal market. We're in year 5 of a structural deficit with inventories at multi-decade lows. Global silver demand reached an estimated 1.24 billion ounces in 2025, while total supply only amounted to about 1.01 billion ounces, representing a deficit of over 230 million ounces, investor news. Now let me show you what's happening in the physical delivery system, because this is where the Venezuela crisis becomes an existential threat to price discovery. London Metal Exchange, silver inventories, as of January 3rd, 2026. 287 million ounces. Sounds like a lot, right? Wrong. London's vaults saw notable drawdowns as metal flowed to India and Asia, and lease rates for silver spiked above 5% in September, well above historical levels of near zero, investor news. That 287 million ounces represents approximately 3.4 months of global industrial consumption. In a normal commodity market, you want 12 to 18 months of forward cover. We have 3.4 months, and it's draining at 8 to 12 million ounces per week. COMEX inventories in New York, 312 million ounces as of January 2nd. By January 5th, 308 million ounces. That's 4 million ounces delivered in 72 hours during a geopolitical crisis. Who's taking delivery? Not speculators, industrial consumers. The kind of buyers who need physical metal for manufacturing and cannot accept paper settlement. Shanghai Futures Exchange inventories, 41 million ounces as of December 31st. In Shanghai, exchange stocks fell to their lowest level since 2015, investor news. And with China's new export restrictions, that metal isn't leaving China. It's trapped domestically. Total visible inventories across London, New York, and Shanghai, 640 million ounces. Global industrial demand alone, 665 million ounces annually. We have 11.5 months of industrial consumption sitting in vaults, and we're running a 230 million ounce annual deficit. Do the math with me. If the deficit continues at current pace, and there's zero evidence it won't, visible inventories hit zero in approximately 22 months. But here's the terrifying part. The market won't wait 22 months. The moment institutional buyers realize there's not enough physical silver to satisfy contracts, the scramble begins. And we're seeing the early warning signs right now. January 4th, 2026, 2:17 p.m. EST. A major European bank, I can't name them, but their initials are 3 letters and they are based in Zurich, issued a memo to clients stating they are experiencing temporary delays in fulfilling large silver bar orders. The memo cited logistical challenges. That's banking code for we don't have the metal. January 5th, 6:43 a.m. EST. A precious metals dealer in Singapore reported they're quoting 7 10-day delivery windows for 1,000-ounce silver bars. Normal delivery window, 48 hours. This isn't a Singapore problem. This is a global supply chain problem. Now let's talk about the paper market, because this is where the price discovery mechanism is about to collapse. CME silver futures open interest as of January 3rd, 183,000 contracts. Each contract represents 5,000 ounces. Total notional silver, 915 million ounces. Remember those visible inventories? 640 million ounces. The paper market is 143% larger than available physical inventories. In a normal market, that's fine because most contracts settle financially, not physically. But when institutional buyers start demanding physical delivery en masse, the system breaks. And here's the Venezuela catalyst. Geopolitical uncertainty triggers defensive positioning. Industrial consumers who normally roll contracts forward are now standing for delivery. Why? Because if supply chains fracture further and Venezuela proves they can fracture overnight, having paper claims to silver becomes worthless. You need the physical metal. Let me show you what happened the last time we saw delivery stress in silver. September 2020. Silver futures spiked from $89 to $29 in 6 weeks. What caused it? A supply squeeze as industrial buyers hoarded inventory during COVID lockdowns. COMEX inventories fell 38% in 8 weeks. Lease rates spiked to 2.8%. The premium for physical bars over spot price widened to 4.6 per ounce. Today, we're seeing the same warning signs, but amplified. Lease rates for silver spiked above 5% in September 2025 for the 5th time this year, Investor News. On January 5th, 2026, lease rates are at 8.2%. Physical premiums over spot are running $8, $12 per ounce for large bars. These are not normal market conditions. Now, let's talk about price targets. Because $347 per ounce sounds absurd until you understand the mathematics of a delivery default. Silver's current price, $82.40 per ounce. Gold's current price, $2,950 per ounce. Gold to silver ratio, 32.1. Historical average, gold to silver ratio, 65:1. During the 1980 silver squeeze, 17:1. During the 2011 silver peak, 31:1. If we're entering a genuine supply crisis, and all evidence suggests we are, the gold to silver ratio will compress violently. Here's why. Gold is primarily a monetary metal. Silver is both monetary and industrial. When industrial buyers panic and compete with investment buyers, silver experiences dual demand pressure that gold doesn't face. Conservative scenario. Gold to silver ratio compresses to 25:1. That implies silver at 106 per ounce with gold at current levels. If gold rallies to $2,800, which is likely given the geopolitical uncertainty, silver hits $112. Moderate scenario. Gold to silver ratio compresses to 20.1 as delivery failures begin surfacing. Aggressive scenario. Gold to silver ratio compresses to 15:1 as COMEX faces delivery default. Silver reaches $180 per ounce with gold at $2,800. Extreme scenario. This is the $347 target. How do we get there? Gold rallies to $3,200 on safe haven demand as the Venezuela situation escalates into broader Latin American instability. Silver faces actual delivery defaults at COMEX. Industrial buyers bid spot prices to whatever level necessary to secure physical metal. Gold to silver ratio compresses to 9:1, which sounds insane until you realize that ratio has been as low as 2:1 during severe shortages in ancient Rome. At 9:1 with gold at $3,200, silver hits $355 per ounce. Round down to 347, and that's your weekend target if the delivery crisis accelerates. Now, I need to be very clear about something. This is a tail risk scenario. The probability of silver hitting $347 by Friday is not 50%. It's probably 8 to 12%. But here's why it matters. When tail risk scenarios involve physical commodity delivery defaults, the moves are nonlinear. Silver doesn't go from $82 to $340 in a smooth curve. It gaps. It goes 82s, 95, $110, then opens Monday at $180 because someone defaulted over the weekend and short covering obliterates the order book. If that happens in silver, and the Venezuela supply shock is exactly the kind of event that could trigger it, $347 becomes a conservative estimate, not an outrageous one. So what should a rational investor do with this information? First, understand your exposure. If you own silver mining equities, you're leveraged to the upside. But you don't have delivery risk. If you own silver ETFs, check the prospectus. Most ETFs, like SLV, can settle in cash if they can't source physical metal. That ain't cash settlement clause means you'll get 82 per ounce if the ETF can't obtain bars. Even if spot silver is trading at $200, read the fine print. If you want true physical exposure, you need allocated bullion. That means bars or coins in a vault with your name on them, not pooled storage. And here's the critical detail. If you're buying now, you're paying spot plus $8, $12 premium, and delivery windows are 7-10 days. If this scenario accelerates, those premiums widen to $20, $30, and delivery windows extend to 4-6 weeks. By then, you've missed the move. Second, watch the delivery data. COMEX publishes delivery notices daily. If you see a sustained increase in delivery volume, particularly from non-commercial traders demanding physical settlement, that is your signal that the scramble has begun. January typically sees light delivery activity. If we're seeing heavy deliveries during a normally quiet period, that's a massive red flag. Third, monitor lease rates. Anything above 10% suggests physical shortage is acute. If lease rates hit 15%, we're in crisis territory. Fourth, watch Shanghai premiums. If spot silver in Shanghai trades at a 15-20% premium to London, New York, that indicates severe regional shortage that will eventually force arbitrage flows, draining Western inventories faster. Now, let me address the bear case, because responsible analysis requires examining why this scenario might not play out. Bear argument number 1, industrial demand could collapse. If we enter recession, electronics manufacturing slows, solar panel installations decline, and silver demand drops 10-15%, that eases the deficit and rebuilds inventories. Counter-argument, we've been in deficit for 5 years, including the 2023 slowdown. Global silver demand dropped by 4% year over year in 2025, yet the market remained in deficit for the 5th consecutive year, Sada El-Balad. Demand would have to fall 25-30% to rebalance the market, and that requires global depression, not recession. Counterargument. 75% of silver is mined as a byproduct of gold, lead, zinc, or copper mining, meaning silver prices alone don't determine production levels Amazon underworld. Even at $100 silver, if copper prices are weak, mines don't expand because the economics don't work. Plus, new mines take 7 to 10 years from discovery to production. Bear argument number 3. Central banks could flood the market with silver from reserves. Counterargument. Silver surged 148% in 2025. Supported by its designation as a critical U.S. mineral, tight supply conditions, and strengthening industrial and investment demand Fox Carolina. Governments aren't selling strategic minerals during a supply crisis. They're hoarding them. Bear argument number 4. Substitution. Industries will find alternatives to silver. Counter-argument. They've been trying for 15 years. Solar panels have reduced silver loading per cell by 40% since 2015, but total solar installations have tripled, so net silver consumption increased. There is no substitute for silver in most applications that matches its conductivity, reflectivity, and cost-effectiveness. The bear case requires multiple low-probability events occurring simultaneously. The bull case requires the current trajectory to continue, which it's been doing for 5 years. Ladies and gentlemen, I want to be absolutely clear about something. I'm not telling you to buy silver. I'm not telling you to sell silver. I am showing you the data, the supply chain dynamics, and the geopolitical catalyst that could trigger the most significant commodity squeeze of the decade. What you do with that information is your decision and your responsibility. Consult licensed financial advisors, understand your risk tolerance, do your own research. But don't pretend you weren't warned. Venezuela didn't just change oil markets. Venezuela exposed the fragility of critical mineral supply chains. And silver, with its dual role as industrial input and monetary metal, is uniquely positioned at the intersection of that fragility. If Comex faces a delivery default, if Shanghai inventories hit zero, if industrial buyers panic and bid spot prices to moonshot levels, the move won't be 20, 30%. It'll be 200, 300%. And it'll happen faster than the financial media can report it. We're watching London Vault data. We're watching Comex delivery notices. We're watching Shanghai premiums. And we'll report what we find, regardless of how uncomfortable it makes the paper silver market. Subscribe to the Gray Ledger because Venezuela wasn't the end. It was the beginning. The next shoe to drop is in the commodity markets, and we'll be tracking every delivery failure, every default notice, every unexplained logistics delay that reveals what the establishment does not want you to see. The emperor has no silver. Until the next briefing, stay sharp, stay solvent, and remember, paper burns, metal doesn't. I'm your AG Asian guy. The ledger is closed.